The dollar holds firm ahead of the Fed's rate decision later this week. Welcome to Market Insight. I'm Ramzan Karamali. Well, traders seem more and more convinced that the Federal Reserve will cut rates 25 basis points on Wednesday, but that the easing path next year will be a gradual one. The pound was one of the few currencies to rise against the dollar after data showed British wage growth picked up more strongly than expected in the 3 months to October, adding to the case that UK rates could take longer to fall than those elsewhere. The Bank of England is expected to keep rates on hold this Thursday. Meanwhile, the yen strengthened very slightly as markets scaled back the chances of a Bank of Japan hike this week in favour of a move in January. But are the markets right in all three cases? Well, to help answer that and more, I'm joined by Francesco Pesole, FX strategist at ING. Francesco, thanks so much for joining us. Well, let's start with the Fed. A rate cut this week seems nailed on, but markets seem more cautious about the future easing path. Are they right to be worried?
Yeah, probably. I think at this stage, really what we expect the Fed to be mostly concerned about is really what's coming next when it comes to obviously the whole policy agenda that Trump is promising to deliver, from obviously from tariffs to fiscal stimulus. In general, expectations are that there will be better growth and potentially stickier inflation. And obviously, if you combine these two factors, despite the fact that the Fed is quite likely to cut rates this week, they will probably look at the future with a bit more concerns on how far they can take this easing cycle to. And we think they will scale back their dot plot projections by 25 basis points, signaling only another 75 basis points approximately in the next year.
So you spoke about the Trump tariffs and about possible more spending next year as well under his administration. What impact could this have on the dollar? And is this what Trump really wants?
So Trump doesn't like a strong dollar. However, we saw in his first term how his policies ultimately did lead to a strong dollar. And we think that the same will happen this time. Obviously, tariffs are a dollar positive in the sense that they're negative for kind of the rest of the world, especially emerging market currencies and the currencies of those countries that have very open economies. But what's really crucial at this stage is that he is really being serious about more fiscal stimulus in the sense of tax cuts. And that is obviously positive for the dollar in terms of a stronger economic outlook, but also what this means for the Fed. And we think that this week we'll get a bit of a confirmation that the Fed will be more cautious and easing, and this is happening at a time where other central banks are actually being more aggressive in easing. We think about the neighboring Bank of Canada or across the Atlantic, the ECB. So this kind of divergence in terms of rates is really what we think will keep the dollar well supported in 2025.
Now, I mentioned in the introduction about sterling getting stronger in light of the wage data. We've got inflation data out tomorrow. Is there any chance anything could steer us off a hold from the Bank of England on Thursday?
I don't believe so. I think today's wage data clearly pointed to the fact that there are still ongoing kind of wage pressure in the UK that needs to be addressed. And this is clearly offering kind of compelling case for the hawks to continue and try to delay kind of the easing by the Bank of England. So obviously tomorrow's CPI will be very important. We think it can have an impact on sort of pricing for the sterling curve for the next meetings. However, when it comes to this week, we think it's quite likely that we'll just see a hold and a pretty cautious tone. We expect only one vote in favor of it.
Now, finally, we know that the Bank of Japan is also looking to hold rates on Thursday, but perhaps hike in January. Now, how's that been impacting on the yen in recent weeks?
Yeah, so first of all, our call has been actually for a hike this week by the Bank of Japan. The reason is that looking at sort of data, inflation is a bit stronger than expected. Earnings came in a bit stronger than expected, and also we saw some improvement in GDP revisions. However, there has been some news and reports suggesting that there is a bit of kind of pushback against hiking a bit early. So January is starting to look more likely, and markets indeed have scaled back those expectations for a hike. When it comes to the yen, well, obviously the fact that dollar rates have remained elevated continues to put pressure, upward pressure on dollar yen, and we doubt this will change next year, even with a rate hike by the Bank of Japan. So we expect a bit of the same when it comes to dollar yen. Still a lot of buying in the dips, and unless we really see a sharp repricing lower in Fed rate expectations combined with a sharp repricing higher in Bank of Japan rate expectations, we doubt that dollar yen will be able to really trade substantially lower in 2025.
Francesco Pesole from ING, many thanks for your thoughts. And that's Market Insight. Don't forget you can watch more videos on Reuters.com.